1.
Hello, everyone. This is Tim Leveroni and Samir Shah. We want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of our investment managers we use. Shortly, I will introduce our speaker, Jeffrey Bookbinder. He will present LPL Financial's outlook on the current markets, interest rates, tariffs, and address concerns of a recession. This call is being recorded today, and there will be no questions during the call. If anyone has any questions, please call or email us. Jeffrey Bookbinder is Vice President and Equity Strategist at LPL. With that said, I will open this up to Jeff.
Great. Thank you, Tim. And thank you, Samir, and the whole Leveroni team for inviting me to be on with all of you today. Really looking forward to a great call and an interactive call, because I think, Tim, you and or Samir are going to maybe jump in with some questions along the way. So let's get right to it.
Great.
Thank you for the introduction. So first slide here shows our 2019 Outlook publication. Hopefully, all of you have had a chance to look at this. I'm especially proud to say that our forecasts, at least thus far, have turned out to be pretty good, because tell you, after that December sell-off, we published this in November. After that December sell-off, some of these forecasts weren't looking so good. So glad we're back on track and stocks are up. Of course, they're up because we had such a strong first quarter, one of the strongest first quarters we've seen in quite some time. A little bit of old news, now that we're well into April, but just real quick, want to make the point that we had growth stocks do best. That's been the case for much of this bull market. Something we think is going to begin to reverse here this year. So we have suggested folks who have big overweights to growth to maybe pull back on that a little bit, because of the strong rally. Some of you may have a little bit more growth stocks than maybe you want. So that's been our positioning here, to begin to tilt a little bit more toward value. And then on the sector side, here on the right-hand side of this chart, we see generally the most economically sensitive sectors have done best. And that is really what you want to see, because the stock market is a signal of the economy. And, seeing sectors like technology, like industrials, energy, and consumer discretionary perform well is the type of performance that we want to see. That's actually continued in April. In fact, the industrial sector, one of our favorites, has hit a 6-month high just last week. Turning real quick to the bond market, the 10-year Treasury yield has actually bounced here this month, but in the first quarter it fell quite a bit. We think the biggest reason why Treasury yields are low, and I'll get into this a little bit more later, but we think the biggest reason Treasury yields are low is because of low interest rates overseas. So we think that better economic growth here, maybe a little bit more inflation, maybe a little bit more wage growth here will help put some upward pressure on yields. But we also need help overseas with interest rates throughout Europe and in Japan pretty much at zero. As I mentioned, that the economically sensitive sectors of the equity market did really well in the first quarter. Well, we also saw the economically sensitive areas of the bond market do especially well. Really, the top 5 categories here in this chart on the right-hand side: preferreds, high-yield corporates, emerging market debt, bank loans, and investment-grade corporates, all very economically sensitive, suggesting investors took more risk in the first quarter as the economic environment improved. So I have this presentation broken out into 4 different sections, and you see them here: policy, economy, equities, and fixed income. So I'm going to go through in between maybe 2 and 4 slides for each section, and pause with the conclusion of each one to see if Tim or Samir have any questions. So let's start with policy. We lead with this because we think it's actually possibly the most important driver of markets. And that was certainly the case last year with tax reform being passed at the end of 2017, and that certainly had a lot of impact on the U.S. economy and on corporate profit growth last year. That's not over. You know, you may have seen in the news folks talking about a sugar high. You know, some are worried that, you know, we had this big stimulus last year, and you know, that drove better growth last year in the economy and profits. Some folks are worried that that's over, right? Well, we don't think that's the case at all. And it's really not opinion. It's actually kind of fact. The way that the tax law was written, we actually see more boost to the economy as measured by GDP, gross domestic product, in 2019 than we saw in 2018. And that's a combination of things. It's tax cuts, which are flowing through still in 2019. It's also the government spending piece. The federal budget that went into effect last year is actually you know, stimulative to the economy, right? Government spends more, that boosts GDP. So we're seeing more government spending this year, and that combined with the impacts of tax reform are actually causing a bigger boost to GDP this year than last. So you could argue there's a sugar high maybe in 2020, and that we're seeing less stimulus from tax reform and government spending in 2020, but there's still the potential for more defense spending when the 2020 budget is passed. And actually, this sort of waterfall decline you see from 2019 to 2020 might not even occur. But still, the most important point to keep in mind here is that government, including tax reform and spending, will help more this year than last year, which not a lot of people are talking about. We don't think that the Fed has overhyped. So, you know, the big worries about recession last year centered around the Fed being too tight. And one of the ways we can measure whether the Fed is too tight is to look at inflation-adjusted Fed funds rate. So the Fed's target interest rate, the Fed funds rate, minus CPI, which is give or take 2%. That number is only modestly positive. The Fed's target interest rate is between 2.25% and 2.5%, and then inflation roughly 2%. So you see here on this chart, this was run a few months ago, but it hasn't changed. Essentially, we're marginally positive. Historically, and you can see this on the chart where you see the shaded bars, we've had to be close to 2% before a recession has begun. So this would suggest the Fed still has room to tighten further before recession. Of course, every cycle is different, but this is an encouraging sign. So why don't I pause there on the policy piece and see if Tim or Samir have any questions on that before I continue into the economy.
Yep, Jeff, thank you. I think the last slide that you had pertaining to, if we can just go back to that for a quick second.
Sure.
The real rate of return, I think it's a great slide and very powerful. Because as we do planning, we talk about the real return and set that expectation that when we're talking about growth, we have to look at it from an inflation-adjusted stand piece. I don't think a lot of people realize that that the past decade has been rather bleak on the real return side. So I think this is really powerful. But the question to you is, does this signify anything going forward?
Yeah, it does. It signals that the economic expansion and the bull market can continue. You know, I'll say it over and over again, every cycle is different because no one can predict the future. But if you have an accommodative Fed or a Fed that is neutral, and you can argue they're either one of those right now, historically speaking, the economy has continued to grow, and when the economy continues to grow, that historically has been accompanied by stock market gains. So I think this bull market, the whole team here in LPL Research thinks this bull market has a little ways to go here. We could see a little bit of an economic contraction maybe in a year or two. It's of course always a possibility, but all of the indicators we watch, not just the Federal Reserve, which is seemingly always part of a recession, but really all of the economic data we watch that has shown any efficacy in predicting future economic growth, they're all suggesting more growth ahead.
Great, thank you.
Thanks for that question. I'll get a little bit more into that, the topic of the economic expansion in a minute here. So we published the outlook last fall, and then we slightly changed our economic forecasts in March here. You see, actually in February. You see here, these were very modest changes to GDP. We were at 2.5 to 275, and we just went to 2.5. You could argue that's not even a change. Inflation, we didn't change at all. The 10-year Treasury yield, we changed modestly, essentially taking it down 0.25%, and then tightening the range. These aren't really big changes. I guess the Fed is a big change because we did think back in September, October of last year that we would get 2 hikes in 19. Now we think there's a fair chance we get 1, but only if the economy improves between now and the end of the year. And even if we do get 1 rate hike at the end of the year, it's probably going to be December. Now that could be a source of some volatility. Given how far stocks have come in the last few months, we could see a little bit more volatility in the next few months. Certainly that wouldn't be a surprise. So the market changing from expecting no hikes or even expecting a cut to interest rates to then potentially expecting a hike later this year is certainly something to watch. So I alluded to leading economic indicators. This is one of our favorite leading economic indicators, which makes sense because it's actually called the Index of Leading Economic Indicators. This is a collection of 10 data points that collectively have historically done a pretty good job at predicting recession. So when this index is up, the odds of recession are low. When this index is down, the odds of recession increase quite dramatically. So these little shaded dots here are inflection points where the index has turned negative on a year-over-year basis. You can see they're really all either at the start of a recession or a little bit before. Lead times vary, but this is something that you have to pay attention to. So here's the good news. This slide's a little old too. We were running about up 5%. Now we're running up about 3%. But that's still a very strong reading. We've actually dipped close to zero here a couple times during this bull market, and bounced off of it. Right. So those were not recession calls, thankfully. We're in a little bit better place now, up about 3.5%, suggesting that economic growth will improve. And before I pause on the economy, I'll just say we had a soft patch in Q1. That's been widely known here, but the data in March and April has gotten quite a bit better. We went from a real stinker of a jobs report in February to now back to the roughly 200,000 pace. We had a stinker of a retail sales report. Consumers were pulling back at the start of the year. The December stock market weakness was certainly part of that. We had a government shutdown. We had some weather disruptions, right? Well, a lot of those temporary drags have reversed already, and now we're back. The retail sales report for March was really strong last week. So, and we know the job data has improved. So we're actually in a position now where consumer spending, the outlook for consumer spending looks quite good. Wages are rising, unemployment's low, and we've practically erased that soft patch. So we'll probably get about a 2% GDP growth number in Q1, which is not great. That was kind of the, sluggish average growth rate for much of this expansion before the tax reform kicked in, and we saw better growth last year. But that could be, that could be it, and Q1 could be the trough. So the economic outlook here, especially if we get a trade deal with China, which is our expectation, the economic growth outlook is getting quite a bit better.
And Jeff,
so any questions on the economy?
We parallel everything that you said in regards to the leading indicators. Is there any concern that the leading indicators can be misconstrued with all the stimulus that's been happening over the years?
Well, there's no doubt that the tax reform stimulus is helping. I just showed you the numbers in the earlier chart. And a lot of people make the case that the Fed, because they kept interest rates so low for so long, that there's this artificial boost. Because I think it's, I think it's widely agreed that the Fed is near neutral right now.
Yeah, we agree. Yeah.
They've been there a little bit of time at this point. So I think, the Fed does have an inflated balance sheet, although they shrunk it a bit, right? The Fed bought all these bonds and, took their balance sheet from something like a trillion to $4 trillion. They're heading back closer to maybe 3.5. So yes, there is some stimulus there in terms of asset prices, but they're shrinking their balance sheet so gradually and carefully, and they've raised rates back to what I think most agree is normal. So I would not say that at this point that we're sort of in this artificially strong economy and we have to come back from a sugar high. There might be a little bit of a slowdown from last year's growth. That's what consensus suggests. But we think we're going to see, 2.5% type growth here, maybe a little less, but probably see that type of growth here for at least the next couple of years.
Thank you.
Great, thank you.
Sure. So let's transition to the equity market. It's been really strong here, and we've essentially erased that entire sell-off in the fourth quarter. You could look at this a couple ways. You could say, well, we're tired now, right? We have to digest these gains, and that's fair. And we recently reduced our recommended equities allocation to market weight because we thought maybe the equity market needed to take a bit of a break. That's reasonable. But at the same time, we haven't gone anywhere in the last 6 months. And we just, I don't know how many of you follow technical analysis, but, these lines are 50-day and 200-day moving averages. Having those lines slope upward and having the stock market, the S&P 500, break through those averages is a positive sign. Stocks tend to do a little bit better than average when we see those conditions. And we've also seen, as I mentioned up front, the more economically sensitive areas of the stock market do better. So you could actually make a case that the outlook for the stock market is even a little bit better today than it was in September, right? We're getting closer to a trade deal with China, and we have the market is more comfortable with what the Federal Reserve is doing. And the market's pretty comfortable, I think, with the corporate profits outlook now. Remember last fall, everybody's worried about an earnings recession and slowing earnings growth and the sugar high I mentioned before. Well, earnings have already slowed. Now they're actually, expectations are for a pickup. And that's typically a good time to own stocks, when expectations are low and conditions are improving. And we're making that, we're in that situation today. I talked about that this morning when we recorded our podcast, our weekly podcast, Market Signals, with John Lynch. That's a good time to own stocks. And so we wouldn't panic here. We would just say being balanced between stocks and bonds is probably a good place to be. And there's a good chance that if we do get a little bit of a pullback, which historically we tend to see after rallies like this, that will be a pullback to buy, not sell. The bull market is maybe long in the tooth. It is the longest bull market ever by how we and most measure it. But again, if we get continued economic growth, which is our expectation, if those leading economic indicators are right, as they historically have been, and this expansion continues, we think the bull market can continue. You might need business spending to pick up, take the baton from the consumer. The consumer's done extremely well recently, probably is going to continue to spend solidly here in 2019, but eventually we're going to need business spending to pick up. Maybe business confidence gets a boost from the trade deal with China, and that handoff can continue. I don't want to talk too much more about the Fed, but just keep in mind the Fed just hiked a few months ago. That's probably the last, or that may be the last hike of the cycle. We would say there's just as good of a chance that we get one more. When the Fed cycle ends, stocks tend to go up in the subsequent 6 and 12 months. So this is a nice period for stocks historically, where the market isn't too worried about rate hikes. And if we do get one more hike, which is certainly a good possibility, that may even extend this pattern, and we could get gains in 2020 following a hike in 2019. So the Fed is your friend at this point. A lot of folks are worried about the inverted yield curve. Well, good news here with the 10-year yield rising recently, the yield curve is not inverted, and only parts of the yield curve inverted. Remember, the yield curve is just the difference between short-term interest rates and long-term rates. So that's like what you're getting with your CDs or your money markets relative to a 10-year yield or a car loan or a mortgage, longer-term rates like that. And so those rates are the spread between those rates are pretty much zero or close to zero, which historically has been a negative economic signal. But the signal typically has not been a fast twitch, right? You've typically had a couple of years between inversion and recession, and we haven't even inverted yet by our definition, the 2s, 10s. So, and by the way, stocks can go up after you invert. So this is something to watch, but is not something to be too concerned about right now. Earnings growth probably peaked last fall, but historically you've had several more years of economic growth and stock market gains after those earnings growth peaks. And by the way, now we're actually expecting earnings growth to accelerate over the balance of the year. Again, that is typically a good time to own stocks. So even though the earnings season that we're in now is probably not going to be great, the most important thing to keep in mind is that we're going to probably have several years more earnings and economic growth before recession, based on that earnings growth peak that we probably just put in. Earnings are probably going to be right around flat in Q1, but here, based on consensus, you can see on the right-hand side of this chart, we're probably going to be back to a normal sort of mid to high single-digit growth rate by the end of the year. If our economic growth forecast is right, this won't be too hard. 2.5% economic growth corresponds to about 5% sales growth. And if you have 5% sales growth, decent chance earnings growth is even better than that. So that's just a quick look at our equity forecast, important sort of concerns for investors on the equity market. We still do think we'll get another 5% or so between now and the end of the year to get to our 3,000 forecast. Actually, it's more like 4%. Maybe about 4% between now and the end of the year in the S&P 500, even if it'll be a little bit bumpy potentially because of how far stocks have come here in just the last few months.
Well, Jeff, everything sounds great.
Excellent. So should I keep rolling?
We can keep rolling.
All right. So I'm an equity guy, so I don't get as excited about fixed income, but you know, my boss John Lynch would get mad at me if I don't do a fixed income section, so I always do. So fixed income 10-year yield. This is just a graphical representation of what I mentioned earlier. We did take our forecast down for the 10-year, and we had been at 3.25 to 3.75. Now we're at 3 to 3.25. We're at around 2.6 now, which is pretty much where we were on this chart, even though this chart is a couple months old. So I think the international yields are so low that European investors and Japanese investors are buying our treasuries, and that is preventing our yields from moving much higher. So it's kind of an artificial flat yield curve. It's hard to predict when those yields overseas are going to rise, because certainly there's some structural challenges in Europe and Japan, but just keep that in mind that you know, a yield of 2.6 on the 10-year seems low, and some people are saying that that's a sign of recession. We would argue it's not the signal that it normally is. Also, with the possibility of another Fed rate hike this year, that could put upward pressure on yields. The Fed shrinking its balance sheet, even though they've announced they're going to stop doing that later this year, that is still having a little bit of upward pressure, putting a little upward pressure on yields. And then we've got, hopefully, better economic growth and maybe a little bit more wage pressure coming in the next several months, because the job market is so strong, at least based on the national statistics. So you put all that together, and we think that's a formula for a little bit of a rise in Treasury yield. Not dramatic, but a little bit of a rise. Here's the yield curve. We priced this just right before I left on vacation last week. So this is an accurate number. We're pretty much high teens on the yield curve right now, based on the difference between the 2-year Treasury and the 10-year Treasury. We think this is the most effective yield curve measure in predicting recession. And we think this is going to steepen a little bit further. If the Fed is on hold and the economic environment gets a little better, you should see this yield curve measure go back into the 20s here before too long. And by the way, another reason why we're not too worried about the yield curve is that the credit markets have been well behaved. So this shows credit spreads for high yield bonds and investment grade corporates. So this is just the difference between high yield bond yields and treasury yields, and then investment grade corporate bond yields and treasury yields. Of course, investment grade corporate yields are higher quality, and those issuers default less frequently, so those spreads are tighter. And the most important thing to note here is that these spreads over the last several months have narrowed. So, and this again is a more timely chart, just priced about 2 weeks ago. So, if you were seeing credit spreads widen like we saw late last year, when folks were nervous about the economy and the markets fell, that would be more concerning. But what we're seeing is healthy credit markets and flat yield curve. So that tells us that the yield curve signal is probably not too concerning here. And corporate America is in great shape, right? Even though we're not seeing a ton of earnings growth in the first quarter, where the earnings season that we're in now, corporate balance sheets are in excellent shape. We had a little bit of margin pressure from the tariffs that are still in place. Some of those are going to come off, it appears, when we get a trade deal with China. And we're getting a little bit of wage pressure, right? That's good for consumers, right? More pay is more spending, but not much. So really, corporate America is in excellent shape. And that's another reason why we think we're going to have more economic growth to come. The last slide, I think it's the last slide on fixed income. So we think you should position portfolios with a little bit more economic sensitivity than the broad bond market. So that means don't get too heavy in treasuries. And you can see here, historically, treasuries don't do as well when interest rates rise. Of course, that's our expectation. So this chart shows you the areas of the bond market do better than treasuries when interest rates rise. And these are actually some of the areas that we like, especially investment-grade corporates, mortgage-backed securities, and high yield. We've actually started buying high yield in some of our model portfolios here recently as the risk-reward between stocks and high-yield bonds levels out. Right? When you have more muted expectations for stock market gains, the bond market starts to look a little bit better. So we'd encourage you to have diversified bond portfolios and not be too concentrated in treasuries. So I will stop there. I'm certainly happy to take questions about the fixed income markets. I know you all read the disclosures very carefully, as you always do. as I pause, actually, I can take questions on fixed income or anything else, Tim and Samir, if you have any other questions here. But I want to just take this opportunity to thank all of you for listening. Thank you, Tim, Samir, the whole Leveroni team. We really enjoy doing these calls and greatly appreciate your partnership with LPL.
Yep, Jeff, thank you for your time. In regard to what you said about fixed income, we're believers in taking on credit risk because going back to inflation and the real return allows our clients to get inflation-adjusted returns since the alternatives don't allow for that, meaning bank accounts, treasuries, etc. So appreciate that slide that you presented.
Sure. Yeah, you want to be ahead of inflation, not match it.
Right. And there's always a fear of a Federal Reserve policy mistake, but right now it seems like we're in a sweet spot. So that sounds like everything's moving smoothly. So thank you, Jeff, for your thoughts on the current market environment. Great job today. And as a reminder, if you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni.com. That's Leveroni.com. We also would like to hear some feedback to help us improve the format of these calls. And also, if you know of anybody who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.